Hello everyone and welcome to another analysis video. Today we will go over Intel Corporation's intrinsic valuation. But before we do that, I want to mention a few things. First, this video is not a financial advice and it is for entertainment purposes only. Second, if you are one of those people who subscribed to the channel recently, I want to say thank you and you have made my day. And if you are listening without a subscription, please consider supporting this channel with 2 clicks only by subscribing and liking this video. It is a very simple thing for you to do, but will motivate me a lot to make more videos. To perform this analysis, I go over the annual reports for the past years, which are the 10K reports that the company has to file with the SEC. This helps me to get accurate information without the need to use Yahoo Finance or MSN Money. And since it is October and Intel Corporation has a calendar year, the company has filed after this annual report 2 quarterly reports for 2022, so I considered the Q2 report in this analysis. And if you wonder where to find these reports, you can go to the SEC website, click Company Filings, and put the ticker symbol. You'll be able to find all the reports that Intel Corporation has to file with the SEC as a publicly traded company. And from this section, you can view the 10K and the 10Q reports, which are the annual and quarterly reports. And if you click here, you can view all the prior year's reports. Before jumping to the intrinsic valuation, I want to mention that Intel Corporation has one type of common stock or equity security with the trading symbol INTC, and they use a calendar year to report their operations. In this file, I collected financial information from all 3 financial statements, the income statement, the balance sheet statement, and the statement of cash flow for the past 7 years. And starting from this video, I will present the analysis in a different way. Looking at the 2021 revenue, it consists of 7 operating segments. The largest is end user products, which is 51%, and this segment includes products that are embedded in the laptops and desktop computers. Cloud service products segment is about 33% of 2021 revenue. The rest of the revenue consists of smaller segments like products for retail, industrial, and healthcare, products for autonomous driving, memory storage, programmable semiconductors, and other segment. As much as revenue is important, the relation between it and the expenses is very important. This graph shows us the growth of the revenue, cost of revenue expense, and operating expenses for the past 7 years. And as you can notice, we don't have any crazy jumps in the 2 expenses in any of the prior years. And their growth is very similar to the revenue growth, which tell us that the management is controlling the business expenses very well. Over here, we have a graph that helps us to compare the revenue for the past few years. The great thing is that the revenue is growing every year, which is what we want to see in any financially healthy company. But I want you to pay closer attention to 2020 and 2021 revenue. 2020 revenue grew by about 8%, while 2021 only grew about 1.5%, which means that the company experienced a slower growth in 2021. The explanation is that probably 2020 year was not a normal growth. Because of COVID and lockdown, people bought more products, which increased revenue for many companies. But the golden question is, would 2022 revenue growth be even slower than 2021? To find the answer of this question, I looked at 2022 Q1 and Q2 reports. And as you can see in these graphs, when comparing Q1 and Q2 revenue with prior years, we find that 2022 Q1 revenue was very strong, but Q2 revenue declined compared to 2021. My explanation is that sometime after March, the Fed started raising interest rates, which caused a slowdown of revenue. And if you look closely at the left graph that contains the revenue for the first 6 months, 2022 looks very similar to 2019 revenue. And I think this is the best clue to forecast all of 2022 revenue. Moving on, to check the sovereignty of this company and its ability to service its debt, we should check the debt to asset levels or ratio and times interest earned ratio. And as you can see on the left graph, The debt level is stable and it is about in the 20s%, which is acceptable. And the graph on the right shows the times interest earned ratio, which is how many times the interest expense the company makes in earnings. Usually we want to see it more than 7 times, but in 2021 it is actually 57 times the interest expense, so it is something we don't have to worry about. Looking at the outstanding shares graph, we see that the company made an outstanding job reducing the outstanding shares from about 4.7 billion to about 4 billion, which is 14% decrease. But it seems that there is a small increase starting from 2021, and that increase continued in 2022 Q2 report because it increased by about 1%. So that is another important piece of information that we have to keep in mind when forecasting 2022 numbers. But to the company's credit, they continued distributing dividends in 2022. As we can notice in this graph, they are increasing their dividends year over year for the past few years. Up to June 2022, they distributed about 50% of the 2021 dividend. So if you like dividend companies, in my opinion, this company should be on your list. Finally, we get to the step where we can forecast 2022 numbers and find the stock fair value. And to do that, I use free cash flow per share forecast and required return on investment. The free cash flow is the amount of earnings from operations available to the company after spending on their assets to keep them up and running. And it is much more precise to measure earnings from operations than earning per share. And the ROI, or the required return on investment, is something that you decide as an investor. Maybe you just started investing, so you accept 3% investments, or your portfolio already consists of 5% investments, and at that point you only want to consider 7% investments. So in my opinion, I think 2022 is going to be a slow year and very similar to 2019, so I forecast the revenue to be 70 billion, which is, I know, less than 2019 revenue because the revenue in that year is 71 billion, but I need to be conservative because it is a slow year. And for the same reason, I forecast the free cash flow to be only 10% instead of 14% in 2021, which gives us 7 billion in free cash flow. Now we know the outstanding shares have been increasing, and to be conservative, I assume issue more stocks from June to December, so I forecast the outstanding shares to be 4,140,000,000 shares. This means that the free cash flow per share is $1.69. And if your required return on investment is 5% and the discount rate is 4.44%, which is, by the way, the T-bill interest rate for 6 months, then the intrinsic value, or the fair value, is 32.31 cents. But if we change the return on investment to 6%, then we will have 26.93 cents. I just want to mention that I'm using the 6 months T-bill interest rate because this analysis is aiming to find the fair value of the stock at the end of this calendar year or by the time of issuing the next annual report, which is around February of 2023. And to find the T-bill interest rates, we can visit treasurydirect.gov, which is the official government website to buy government debt securities. And if we click on Treasury Marketable Securities and then Treasury Bills, click on Results of Recent Bill Auctions, and again on 20 Most Recent Auctions, scroll down until you find the recent 26-week, and here you go, it's 4.44 the interest rate. Looking at the stock price chart for the past month, it seems that it's ranging from 25.04 cents to 29.07 cents. And it seems that our fair stock value is in between those two numbers, because we said the fair stock value using 6% return on investment is 26.93 cents. This is it for this video. Thank you for watching it to the end. Please consider subscribing and see you in another video.